Welcome back to the Deep Dive. Today we're digging into a story that's really made some noise lately. The pretty dramatic events around Opendoor Technologies.
That's right.
We're talking about a company in real estate tech, which is already, a volatile space.
Mhm.
And its stock just saw this huge surge after a big leadership announcement. It's the kind of thing that really makes you stop and ask, okay, what's actually going on?
Yeah, what's behind the curtain?
Exactly. Why Opendoor? Why now? And maybe most importantly for you listening, is this like a real turning point for them, or is it just market hype that might fade?
That's the core question.
That's what we're trying to unpack today.
Indeed. And this deep dive, it's really focused on getting behind that headline. We've looked at sources covering the leadership changes at Opendoor, the market's, frankly, kind of wild reaction.
Well, wild is a good word for it.
And also, really importantly, a critical look at their business model. So our mission here is to break down what these changes might actually mean for Opendoor and maybe for the whole iBuying industry. Hopefully, by the end, you'll have a clearer picture of whether this is a genuine reboot or if they're still facing those same old fundamental hurdles.
Okay, let's definitely unpack it because the story kicks off with, well, quite a bang. Opendoor Technologies ticker OPEN saw its stock jump 80%, 80, in a single day.
It's staggering, really.
I mean, it's not normal for any stock, let alone based mostly on a leadership change announcement. It almost feels like investors were just waiting for anything.
Yeah, some kind of signal.
Right. And to give you some context, the research pointed to an example. Remember when Starbucks hired Brian Niccol, their stock went up 24%? That was considered big news.
A very respectable jump.
Sure. But even that pop didn't fully hold.
Yeah.
Opendoor's 80%. It just puts the sheer scale of this reaction into perspective. It's like this collective gasp of maybe hope or just intense speculation.
Well, and what's fascinating is comparing this to Opendoor's past performance. The company's seen hype before. Some sources mention that meme stock rally phase where it got compared maybe loosely to Carvana.
Right. I remember that.
But this recent surge feels different. The analysis really stresses that this time it seems tied to what they're calling real changes inside the company.
Right.
Not just general market mood swings or, those speculative comparisons. It's a contrast between that earlier hype and what looks like a reaction to actual concrete news. Investors are obviously thrilled by whatever catalyst they're seeing.
So these real changes, what are we talking about
Yeah.
specifically? What drove that 80% reaction? It starts with the new CEO, Kaz Nejatian.
Mm-hmm.
And his background, well, it's definitely eye-catching. He was COO at Shopify.
Which is, a huge name in e-commerce platforms, very well regarded.
Exactly. The sources call it one of the best-regarded tech commerce platforms. And before Shopify, he founded a payments tech company called Cash, sold it back in 2017.
So a track record in tech and scaling platforms.
Right. And Nejatian himself, he posted on X, formerly Twitter, saying he wants to redefine what's possible in real estate. He drew a parallel to Shopify, hoping to do for homeowners what Shopify did for entrepreneurs, basically, build a platform that meets their needs at scale.
That's a bold ambition.
It definitely is. Big promise.
And if you connect his specific background to Opendoor's situation, it seems quite strategic. Shopify, as you said, massive in e-commerce software, helping businesses get online and grow.
Right.
And crucially, Nejatian was involved in rolling out Shopify's newer AI tools. And the sources flag AI as a key focus for Opendoor's planned revamp.
Okay. So there's a direct link there.
Seems like it. His expertise isn't just general tech leadership. It appears aligned with platform building, AI deployment, the very things Opendoor says it needs.
Interesting.
And beyond Nejatian, there was another big move, bringing back co-founders. Keith Rabois is now chairman, and Eric Wu is back on the board.
Right, the original guys.
Yeah. And the company's press release explicitly mentioned injecting founder DNA back into the company.
Founder DNA.
Okay.
What does that actually mean in practice, do you think? Especially given their history.
Well, that's the million-dollar question, isn't it? On one hand, founder DNA could mean passion, vision, that initial drive, maybe a return to aggressive growth, trying to capture market share.
Which they did before.
But on the other hand, you have to remember the context. It could also imply returning to the original vision that struggled to achieve profitability the first time around. So it could be a double-edged sword. You get the energy, maybe the innovation focus, but potentially also the same strategic pitfalls if the underlying business model issues aren't addressed head-on this time.
That's a really critical point.
Yeah.
Because, you have all this excitement, the huge stock jump, the star CEO, this talk of founder DNA.
Right.
But then there's this piece of information from the analysis that just hangs there. Opendoor has never been profitable.
Never.
Not even when those founders, Rob Wah and Wu, were running things before. So for you listening, what does this actually mean for the core business? Can a company with that history suddenly find profitability, even with a tech leader like Nejatian? Or is the problem, deeper?
It points to a fundamental challenge, absolutely. And we need to look closely at how Opendoor actually operates. Their main business is iBuying, buying homes directly from sellers online, then reselling them.
The instant offer model.
Pretty much. They also make money from fees on related services, so they're acting as a kind of middleman in the transaction.
Yep.
But here's the detail the research really highlights. Opendoor generally doesn't do renovations.
Oh, interesting. I might have assumed they did some light fix-ups.
Apparently not significantly. Their
Yeah.
stated goal is to make money by making the buying and selling process faster, more convenient, using tech to smooth things out.
Okay.
But that immediately raises the question. How do you create a sustainable profit margin if you're not really adding tangible value to the house itself through improvements?
Right. Where does the profit come from then?
Well, think about it. Successful middlemen usually operate on huge scale with tiny overheads. Or they offer convenience that people value so highly they'll pay a big premium.
Okay.
In real estate, transaction costs are already high. Buying and holding thousands of houses requires massive amounts of capital.
Yeah, it must be billions.
Billions. And the assets, the houses, they're not liquid. You can't just flip them instantly like stocks. Market shifts can wipe out your margins fast.
So they're taking on a lot of risk.
A huge amount. Without renovations, they're basically trying to profit by buying just under market, selling just over, plus a service fee,
Yeah.
all while paying carrying costs, closing costs, and bearing the risk the market dips.
That sounds like incredibly thin margins.
Extremely thin. And accurately pricing thousands of unique homes across different markets, day after day. That's a massive challenge in itself. If your main selling point is convenience, the market has to put a really high price on that convenience to cover all those costs and risks. And looking at their history, well, the numbers suggest it hasn't, not consistently anyway.
And it's not like Opendoor's alone in finding this tough. If we zoom out to the iBuying industry as a whole,
Yeah, the broader context is important.
the articles point out that Zillow and Redfin, both major companies who tried this, they eventually bowed out of the iBuying game. They shut down those operations entirely.
Right, they decided it wasn't workable for them.
And that really underlines how hard this model is, doesn't it? It wasn't just one company struggling. It seems like a systemic issue within the iBuying concept itself. Maybe less about how you do it and more about whether it's fundamentally economical at scale.
Which, brings up a classic investing dilemma. The material we looked at referenced that famous Warren Buffett quote.
Let me guess. The one about management versus business economics?
That's the one. When a manager with a reputation for brilliance tackles a business with a reputation for bad economics, it's the reputation of the business that remains intact.
Ouch. That feels pretty pointed in this context.
It does seem applicable, doesn't it? We have Kaz Nejatian, clearly brilliant, impressive track record at Shopify.
Right.
But can that brilliance overcome what the analysis suggests are just really tough, maybe even bad economics in iBuying? Think about the risks holding all that inventory if the market turns.
Yeah, thousands of houses.
The sheer amount of capital needed, the operational costs of managing properties everywhere, even without major renovations, all these things squeeze the margins incredibly tight.
Makes the whole thing very vulnerable.
Very. So even with this exciting new leadership, the conclusion from the sources seems pretty consistent. The odds still seem stacked against Opendoor and the iBuying business model overall. It's like bringing a world-class architect to fix a fundamentally flawed foundation. The skills might not match the core problem.
It does sound like a daunting challenge. But okay, are there any potential bright spots? Any tailwinds, as they say, that might give Opendoor a bit of help?
Well, the economic outlook offers one potential positive.
Okay.
The sources mention expected interest rate cuts from the Federal Reserve. In fact, they're anticipated possibly as soon as next week.
Rate cuts.
Yeah.
That would definitely impact the housing market.
Absolutely. For a business like Opendoor, which relies heavily on real estate transactions and also needs to finance its huge inventory, lower rates could be a significant help.
Could make borrowing cheaper. Maybe spur more buying and selling activity.
Potentially, yes. It could provide some much-needed relief and maybe stimulate the overall market they operate in. So that's certainly something positive on the horizon.
Okay, so a potential boost from the Fed.
A potential boost. But, we need a balanced view here. The research rightly points out that Nejatian deserves some time to put his imprint on the business.
Sure, he just got there.
Exactly. He needs a chance to implement his strategy. He's walking into a tough situation with huge expectations, but even with potential tailwinds like rate cuts, the big picture conclusion doesn't really change. Building a sustainable business model in this industry still looks difficult.
So lower rates might help, but they don't fix the fundamental iBuying math.
Not necessarily, no. Those core issues, the inventory risk, the capital intensity, the thin margins, they don't just disappear because borrowing gets a bit cheaper. So what we'd really encourage you, the listener, to do is keep your eye on what changes Nejatian makes. How does he specifically tackle those core economic problems?
Right, look beyond the headlines.
Exactly, and watch how the housing market behaves over the next year. Those factors, Nejatian's specific actions in the market environment, will be the real test of whether this is a genuine turnaround or, just a temporary sugar rush fueled by hope and lower rates.
This whole deep dive, it really sets up a fascinating conflict, doesn't it? On one side, you've got this incredible market reaction, the 80% jump, the promise of this dynamic new CEO from tech darling like Shopify.
The Shopify pedigree.
And this idea of injecting founder DNA, whatever that ultimately means.
Yeah.
It's a powerful story of revival, of tech-driven change.
A compelling narrative.
But then on the other side, you have the cold, hard facts. Opendoor's history of unprofitability. The fact that the iBuying model itself seems fundamentally challenging, pushing out giants like Zillow and Redfin. And this basic difficulty of making consistent money just by being a faster middleman without adding physical value.
Right. The narrative versus the numbers, in a way.
Exactly.
And that leaves us with, I think, a pretty provocative thought for you to take away and consider. Given everything we've discussed, drawing on the analysis, can Opendoor, with its new leader, its focus on AI and convenience, truly redefine what's possible in real estate? Can they leverage tech to overcome those historical hurdles? Or will that Buffett quote hold true? Will the reputation of the business, its underlying economics, its inherent difficulties ultimately win out, no matter how brilliant the leadership is? It really boils down to a fundamental question. Can vision and technology conquer tough industry economics? Or do those economics inevitably shape the outcome? That's something to keep in mind as you watch how this next chapter for Opendoor unfolds.